were there levels on the 10-year, specific levels that you were worried about? I've heard people were saying, like, if it goes over 450, then we have an issue, and it didn't. So everyone was more sanguine.
Well, we didn't get back above 450 this year. We got close to it.
Right.
We actually put that, we'll take credit for that, good and bad. We put that 450 number out a couple of years ago. And then all of a sudden now it became kind of a thing. Okay, I actually worry more about bond volatility, because that affects liquidity, okay, and that really is a bigger driver for asset prices. Now, if we were to go through 450, it also depends on why we're going through 450, okay? If it's because growth is spectacular and inflation is under control and the Fed doesn't have to raise rates, I think that's okay. But if we're going up because inflation's a problem again and then the Fed has to get hawkish, then we have an issue. So right now, I'm not worried about rates. I don't think that's going to be an issue for the market. Valuations are totally fine here, 21.5 times earnings, given the earnings picture. And that's been our thesis all year. We haven't wavered on that, right? That this earnings recovery is a lot stronger than people think.
I hadn't thought about the fact that you made that 450 call a while ago. Does that mean every time the market has sold off because that people have called you up and been like, Mike, this is all your fault.
No,
Why did you put this in our heads?
Actually, no, they take credit for it instead.
Okay, fair enough.
No, I'm teasing, but like that's the game, right? It's like once you, and by the way, I figure out things from other people too, where it's like we identify something that works and then the market kind of trains itself.
Right.
I don't think, to match question though, I don't think that level of 450 is nearly as important today, okay, because of the earnings picture as it was, say, 2 years ago when earnings were very tepid. The bigger issue, the bigger risk, if there is one right now, would be if bond volatility were to pick up again, which is probably more a reflection of the conflict in Iran or some other external event. Like private credit starts, percolating again on the negative side. Something like that, I think, would be much more of a headwind for equity multiples than just a level of rates.
Right.
Yeah, earnings expectation. I keep looking at this EEO page on the Bloomberg terminal. S&P earnings 12 months out, 328 for the blended. It's like 350 already, and it's just, I mean, that's 23, 24% growth.
Right, there's a simple measure. Just look at NTM, rolling NTM earnings per share. Whenever that's going up, which it has been, it's very hard to see the market.
Does it not make a difference, though, that like so much of it, and I've been talking about this because our MLive team has been doing great work, it's like all Micron. So many of the earnings upgrades have been Micron. It's very concentrated, that.
Well, it's actually not true. I mean, that was the case last year.
Right.
The earnings, the broadening of the earnings story has actually been very impressive, something that people have underestimated. So I'll give you an example. The median stock within the Russell 3000, okay, so this is like the 1,500th largest company in the broader market, is now growing earnings close to 14% year over year. So that broadening story, I think, is still underappreciated, which is why we want to go back to some of these areas that got pummeled when oil prices went up. So, for example, consumer goods or some of the industrial stocks. Financials is an area we doubled down on like 3 weeks ago.